Well, let's split it up in two parts. The Chinese equity market has its own dynamics. It did fairly well at the beginning of the year at the back of macro. Then it folded in when there were restrictions on margin trading. And then, of course, there was the cut in interest rates by the People's Bank of China. So it isn't a huge surprise that they cut reserve requirements. Mind you, reserve requirements, they were nearly at 20%. Now they're down on 19.5%. And a few years back, they were something like about 6 or 7%. So they have really increased them massively. So it is a small change, but it is on par with what they're doing. Point number one. Point number two is, will this affect Asian markets? The answer is no, not at all, okay, because they are completely unconnected. For example, the Indian market, the Filipino market, and even the Thai market have been doing exceptionally well at the time that the Chinese market hasn't. So the answer is no, there is no relationship between them. The third point is will this really affect the Chinese equity market on its own? And I think you might have an initial kick-in reaction, but I think there are still too many things hanging in the air, including the obsession whether the GDP growth is going to fall below 7% and how this is likely to affect earnings. And of course, we are coming up to Chinese New Year where everything closes down for, 2,000 days or whatever. And that is not going to be really very conducive in getting market reactions out of that. So the answer, overall, if I summarize those, is yes, it's good news, but on par with the course of what the Chinese authorities have decided. In other words, slightly, progressively looser monetary policy in the context of a slowing down economy. Will this really impact equity markets? The answer is if there is an impact, it's going to be temporary, and the impact on Asian markets effectively is going to be none. Another cut in interest rates, I don't think this is on the cards because they tend to be very, very careful and very, very mean when it comes to cutting interest rates. They prefer to sort of twiddle the knobs of either quantitative controls, in other words, not market-related controls, like telling to the local authorities, as they had, loosen up on mortgages, make it much easier to get a second mortgage, drop their sort of deposit requirements, rather than cut another interest rate, another cut in the interest rates. So perhaps another drop in the reserve requirements. You will be very much on par for the course.